How do variable expenses impact an insurance agent's finances? Imagine running a business where some costs change every month based on how much you sell or how many clients you meet. That's what variable expenses are for insurance agents. These costs can include commissions paid to agents, marketing and advertising, travel for client meetings, office supplies, and sometimes utilities that go up with usage. Because these expenses change with your activity, your cash flow can become unpredictable. If sales increase, commissions and marketing costs will go up too. That means you need to manage your cash carefully to make sure you have enough money to cover these rising costs. If you don't plan well, you might find yourself short of funds when expenses spike. Budgeting for variable expenses is trickier than fixed costs like rent or insurance premiums. You need to look at past sales data and forecast different scenarios. For example, if you expect sales to grow by 10% next month, you should also estimate how much that will cost in commissions and advertising. Without this, you risk underestimating your expenses and facing surprises that hurt your profits. These expenses also directly influence your profit margins. When sales go up, commissions and marketing costs increase, which can eat into your net income if you're not careful. Monitoring these costs closely helps you find ways to cut unnecessary spending. For instance, you might negotiate better rates for travel or limit advertising to the most effective channels. Variable expenses also include incentives like bonuses or commissions that motivate you and your team to sell more. While these motivate better performance, they also mean your costs rise with your income. You need to include these in your financial plans to avoid surprises. Understanding and tracking variable expenses helps you create more accurate budgets for your personal and business finances. Regularly reviewing these costs allows you to adjust your spending, prepare for slow periods, and invest in activities that give you the best return. For example, if you notice travel costs are higher than expected, you can plan fewer trips or find cheaper options. Practical steps include tracking commissions as a percentage of sales to forecast monthly costs, planning marketing budgets based on client goals, and monitoring travel expenses to ensure they match your revenue. Using budgeting tools can help you model best and worst-case scenarios for these costs. Reviewing expense reports regularly helps you spot unexpected fluctuations early and adjust your strategies accordingly. In the end, managing variable expenses is about staying flexible and aware. By keeping a close eye on these costs, you can maintain steady cash flow, improve your profitability, and grow your insurance career with confidence.